Hey James, this is Leonard, aka the Poker Paparazzi, and I had a couple of questions that I wanted to run by you. I'm gonna go ahead and break these up into segments. So the first question I have is I've been hearing about a product that's being sold by another life insurance agent. It's called the MPI, or Maximum Premium Index, so some sort of fund, and I believe it's built on a index universal life policy. So I was wondering what makes this type of policy special, and I was wondering if you had any programs that were similar to an MPI. Thanks.
All right, good question. So, some of you may or may not be familiar. This guy's on YouTube quite a bit. MPI. I think his name is Curtis. I'm a bit familiar with him and with his program. I've seen one of his presentations. He utilizes an IUL, and from what I gather from it, he's got a marketing. His marketing on it is all about how they're going to provide some type of a match so that you can increase the amount of premium that you're going to end up paying each year. And in the presentation that I read, it made it sound like it was something that was exclusive to MPI, that MPI was going to be providing that match. It doesn't. There isn't a whole lot of details in the presentation. There's a lot of numbers. There's a lot of promises as far as what you can earn and the type of interest rate that you can get on it, type of growth you can expect from it. My impression of it was it's a bit rosy, and I talked to him on his channel about this. He doesn't talk much about the downsides of the IULs, and that's what he's basing this whole plan on that he's presenting. So that's one of the issues I had with it. And then when I came to the match portion of it, I was like, oh, this is intriguing. You're going to do a match, and if you dig into it, it looks like right at the end of it, it reveals what it actually is. And what it is something similar to what we talk about doing here, which is we just use the cash value that we generate in our policies in order to borrow against it and then put money back into your policy so that you get up to the MEC limit. Now, on my videos, I talked about using a line of credit to do that, where we start with the line of credit and then we pull from the policy and put money back in and pull and put it back in until we hit our MEC limit for each year. His is similar to that, except it doesn't use a line of credit, and it starts with your cash at the beginning of it. They make it sound like they're matching it, but they're not matching it. Really what it is it's just you using the cash value from your policy. This was my understanding. So if any one of you have actually worked with him and this is different, let me know. If you find out that this is correct, let us know. It'd be good to know either way, because obviously I'm not going to be buying a policy from him. But that's my impression of it. So they've got the match, which is essentially the same thing that I've been pitching. So on the face of it, I'm okay with what they're presenting as far as a product. The qualms that I have about it are just, I think he's being a little unrealistic in their presentation. And so I hesitate. How do I want to put this? I hesitate to wonder, or I'm concerned about his clients and where they'll be, 10 years, 20 years down the road when that policy doesn't actually perform as he's basically convincing them that it will perform at. So when I talked to him, I said on his channel, when I was addressing what I had seen, I said, look, you're being really rosy. All of your projections are like best case scenario, but you're presenting them as if it's a conservative guess, as if a 7% compounding growth is a conservative growth rate to project. And I don't think that that's a conservative. I think that's kind of at the high end. Most IUL carriers right now are limiting what you can illustrate to somewhere between 5 and 7%. So like 7% is at the top end of what we're seeing. Now that's before bonuses, of course. After bonuses, so depending on which carrier you're using, after bonuses you can certainly get above 7% based on the illustrations. But if any of you are agents out there, you know an illustration, or if you've owned one of these, an illustration is only good on the day that it's printed. They have to make assumptions about moving forward. How are we going to project these policies to perform? And when it comes to a whole life policy, those projections are based on the dividend rate that the companies are currently earning, because that's how we get above the guarantees that come with those policies. When it comes to IULs, the projection is on, we're going to look back at the historical performance of the indexes that you're tying to, and we're going to project those out going forward. Now, the industry has done a much better job lately of regulating what gets illustrated. It used to not be controlled, and the numbers that were being illustrated were just crazy high, and people weren't actually seeing that performance. Now, cap rates used to be higher than they are today. So some people had some good years and there was some really good performance. You could see maybe 11 or 12 or 16% growth that was happening back when we had that nice bull run of the stock market. We're in a different environment now. This is the first year, obviously, we hit a recession and numbers tanked for a lot of people. So different environment. And what did we see happen from the insurance companies? When the volatility kicked in, they all reduced their cap rates. And this was something that Curtis at MPI did not address. He doesn't even account for it. I said, when I had talked to him, I said, you've got to assume, or you at least have to acknowledge that there's a risk here that when we get into a volatile stock situation, these insurance companies can reduce these cap rates. And the contracts that we get into with IULs allow them to reduce those cap rates really, really low, as down to 3 to 5% for a cap rate, which is extremely low. And if they reduce their cap rates down to 3 to 5%, you are not going to get a 7% average. You're not going to get a 10% average. You're probably not even going to get that 5% average if 5% is the cap rate. So that's my concern. I want you guys to know what you're getting into. If I am a fan of the IUL products, but we've got to be realistic. When I do an illustration, I dial it back a bit. I'd like to dial it back to a 6% growth rate. And that way, 10 years down the road, 20 years down the road, if you're at 6%, you've got what you expected. If you're above that, you're thrilled. If you're below that, shouldn't be hopefully too much below that. But it's a big difference because, man, when you start increasing those interest rates in the projections, the numbers just skyrocket. And they're very, very attractive. So I understand why people are drawn to these products. I'm drawn to these products for the same reason. Growth potential. But you got to remember, that's just the potential. It's not guaranteed. There is an equivalent, at least as far as the products that I'm aware of. So I like the Allianz product when it comes to potential cash growth. They have an awesome bonus option that's available. They have that charges you a 1% asset fee. They also have a good bonus option that is free. Both of those bonus options really give you the potential to jack up the growth in your policy. So I really like Allianz for that. When it comes to, and this will come up in one of the later questions, but when it comes to the top companies that I like to work with, National Life and Allianz are the top two as far as the IUL goes. And Allianz, the reason they're in that top two is because of their potential growth opportunity as well as the guarantees that come along with that their bonus options have some guarantees that you just don't see with a lot of other companies. And then the asset charge also is lower than the asset charge that you see from other companies that attempt to offer some really high bonuses. So that's where I put Allianz at. And when it comes to putting money in, borrowing from your policy in order to get back up to your MEC by putting more back in, we can do that with any IUL. So it's not anything special that MPI offers. Their marketing says that it's a unique thing that they do, and it's really not. It may be unique in how they present it to people. So if you're not aware, and if that's the only people you've been talking to, it's easy to buy into that. So Top Gun, I've been trying to shop around for the best rates. You've seen under 3%. He uses 4%. I've seen HELOCs as low as 2%. Okay, he uses 4%. I didn't see that in the presentation. I thought, oh, maybe that's what Mutual's rate is. And I might have just skipped over that. So yeah, Allianz has a 5% fixed rate that's out there. So it's possible that Mutual of Omaha, if that's what he's using, that they offer a lower variable interest rate. Maybe it's a fixed interest rate. Let me know if you know the answer to that. They just match with your gains and automatically reinvest the gains. Yeah, they don't really match it though. From what I read, it didn't look like they were matching it. What it was they were just showing you how to match by pulling out your cash value and putting it back in. You can't shop around for the best interest rate on a cash value life insurance line of credit. Maybe. I know that there's some banks that will do a line of credit. I know I'm working with at least one person in Illinois who works for a bank. He's a bank executive, and he's planning on, one of the guys in his office is planning on setting him up because he doesn't set up the lines of credit, but somebody else in his office does. He's planning on getting a line of credit from the bank for, I think it was 2%, somewhere right around 2%, that they're willing to do a line of credit against the cash value in his policy. So it is an option out there. It might be tough to find. So if you would like some more information on that, or if maybe you want a heads up, I can try and ask him. See what bank. I think it's U.S. Bank is who he works for. This was a question asked and answered during one of our WealthCare Wednesdays live streams. If you have any questions, leave them in the comments section below, or join us on one of our WealthCare Wednesday live streams where you can ask the question and we will answer it on the air live. I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.